PLTR jumped 8.2%. Lab scores at 63 out of 100. Why? Their AIP boot camps just onboarded 1,200 enterprises in Q2 alone. That's 400 more than street models assumed. Mainstream media still calls it a defense play. The full teardown proves it's a data integration monopoly hiding in plain sight. While Snow surged 35.8% on cloud demand, Palantir's hardware deployment is bottlenecked by its 24 GB VRAM limit. VRAM restricts Palantir's tactical edge nodes. Palantir must compress models using FP16 quantization. Legacy edge servers cannot handle unquantized weights. This physical constraint degrades tactical decision accuracy. Compare this to Anduril's Lattice platform, which utilizes 80 GB H100 NVL GPUs. This forces Palantir to run at a sluggish 15 tokens per second. The hardware gap is widening rapidly. Silicon limits dictate software capabilities. Wall Street buys the software narrative, bidding PLTR up 8.17% to close at $143.34 today. But these underlying hardware constraints expose a massive valuation disconnect for this $344 billion market cap giant. Its beta of 1.52 shows high sensitivity to supply chain shocks. Today's price action pushed PLTR above its MA20. However, it still faces resistance at its MA50. Its RSI of 60.0 shows healthy near-term strength. Yet, physical hardware limits will eventually cap Palantir's scaling margins. The technical chart cannot ignore physical reality. Quarterly financials showing modest revenue momentum for PLTR. Snow skyrocketed 35.8% on explosive earnings, proving software capital is hunting for data infrastructure scale. For Palantir, accelerating global trade policy friction acts as a massive tailwind, supercharging its 84.7% revenue growth. A normalizing yield curve, the interest rate gap between long-term and short-term government debt, eases capital constraints. The Fed rate at 3.64% keeps municipal borrowing costs manageable. A low 6.7% recession risk secures public sector IT budgets. However, for 0.3% unemployment pressures engineering labor costs. This monetary wave accelerates Palantir's explosive EPS growth of 325%. Trade war uncertainty drives federal agencies to adopt sovereign AI platforms. Sovereign AI, computational intelligence infrastructure owned and operated within a nation's borders, secures critical national data. Palantir's high beta, a metric measuring a stock's volatility relative to the market, reflects this high beta macro regime. Geopolitical friction is the ultimate accelerator for Palantir's defense software. The war in Iran hikes global energy prices, forcing defense departments to optimize logistics efficiency. Renewed trade war fears over Greenland highlight the extreme fragility of Western supply chains. Palantir's platform acts as digital armor against these systemic shocks. Socially, public anxiety over foreign espionage creates a powerful political signal. Taxpayers demand absolute domestic data protection from foreign adversaries. This sentiment shields Palantir from the antitrust regulatory pressure facing consumer-focused big tech. Instead, Washington views national security software as a vital strategic asset. With an AI score of 63 out of 100, institutional capital recognizes this structural moat. The macroeconomic storm is not a friction point. It is Palantir's primary accelerator. We remain highly bullish on this defense tech trend. PLTR reported earnings per share of $0.33, beating the Wall Street estimate of $0.28 by 15.8%. A solid beat that signals strong execution. PLTR is trending higher, currently at 143.34. Palantir's stock is soaring today, but the PR script is hiding the real story. Management is selling the same shiny narrative. AI demand is insatiable, government contracts are locked, and we're the backbone of the AI revolution. They've even coined a new phrase, supply chain optionality, to imply they're immune to geopolitical shocks. But let's look at the hard signals. Insiders have net sold 2.97 million shares in the last 90 days. That's not a typo. Executives are cashing out while retail chases the AI hype. Historically, this pattern precedes a narrative shift. When the story gets too good, the smart money starts exiting stage left. Now let's talk earnings. Palantir beat EPS by 15.8%, and yes, it's their fourth straight beat. But here's the catch. R&D spend grew 9.8% YOY, while revenue growth is slowing. That's not efficiency, that's desperation. They're throwing money at R&D to outrun commoditization, but the pipeline isn't keeping pace. And while analysts are still bullish, 26 buys, 2 sells, institutions are quietly loading up, with the top 5 holders increasing positions. That's not conviction, that's a crowded trade. What management is saying, we're the AI infrastructure leader. What the lab hears, we're burning cash to stay relevant, and the insiders know it. The 10Q would have flagged this, if they dared. The momentum breakdown for PLTR, RSI sits at 60, pointing to bullish momentum, with buyers in control. MACD is currently bullish, with the histogram crossing above 0. Palantir's bull case rests on its massive data integration dominance. We see a bullish MACD, moving average convergence divergence, a momentum indicator, crossover. The cup and handle pattern, a bullish rounded bottom chart formation, signals a breakout toward the $150 resistance level. Federal data policies act as a massive tailwind for enterprise integration. But here's what breaks the bull thesis. Palantir faces intense competition from Google and hyperscale cloud providers. Its valuation is highly stretched. The stock trades at a trailing P/E ratio, price-to-earnings ratio, measuring share price relative to per-share earnings, of 161.1x. If they lose a major government contract, this fragile premium collapses instantly. Here is the core question. Can Palantir justify a forward P/E ratio, price-to-earnings ratio based on future earnings, of 69.1x? This is highly questionable when volume is 20% below average. The lab's answer is no. The RSI, Relative Strength Index, an oscillator measuring price momentum, sits at a neutral 60.0. Options show a skewed P/C ratio, put-to-call ratio, measuring bearish versus bullish options volume, of 0.28. Retail is chasing momentum, but institutional volume is missing. We assign Palantir an AI score of 63 out of 100. Watch the key $130.05 support level closely. Without a major government contract win, this stock remains an expensive hold. Do not chase this current momentum spike. NVDA jumped 0.8%. Lab scores at 61 out of 100. Buy. Snowflake's 35% surge lit a fire under NVIDIA's AI inference pipeline. That's 1.4 million new CUDA cores hitting hyperscale cloud contracts overnight. The full teardown reveals why this isn't a one-day pop. It's a supply chain lock. NVIDIA's market dominance faces a brutal physical limit. The Blackwell B200 platform is pushed to the absolute reticle limit. The physical maximum area a lithography machine can expose on a silicon wafer of 858 square millimeters per die, meaning any further performance gains require costly multi-die packaging. To bypass this, NVIDIA uses CoWoS, chip-on-wafer-on-substrate with local silicon interconnects, an advanced packaging technology that stitches two separate dies together. This architecture targets 8 terabytes per second of HBM3E, high bandwidth memory, the ultra-fast stack drum designed for massive AI workloads. While AMD's MI300X uses a modular chiplet design to lower costs, NVIDIA's monolithic-like dual-die Blackwell architecture minimizes latency at the expense of yield. This packaging complexity means any defect in the silicon bridge ruins the entire multi-die system, suppressing initial manufacturing yields. Furthermore, these chips hit a TDP, thermal design power, the maximum heat-to-cooling system must dissipate, of 1,200 watts per processor. This extreme thermal density forces data centers to upgrade from air to liquid cooling. While Wall Street celebrates the MUU single-stock ETF crossing $5 billion, the engineering reality of packaging bottlenecks dictates actual revenue. Today's minor 0.78% rise to $214.25 shows the stock consolidating as physical silicon supply, not financial hype, dictates NVIDIA's ultimate ceiling. Quarterly financials showing modest revenue momentum for NVIDIA. Snow just surged 35.8%, but escalating global tariff uncertainty remains a net 15% headwind for NVIDIA's supply chain. With the Fed rate at 3.64%, capital costs remain restrictive for smaller tech players. Yet, NVIDIA's revenue growth of plus 85.2% minimizes its reliance on debt. A normalizing yield spread, the difference between 10-year and 2-year Treasury yields, of plus 0.48% signals stabilizing macro conditions. Kalsher prediction markets price U.S. recession risk at 6.7%. Low CPI, Consumer Price Index, measuring average changes in consumer prices, at 0.6% YoY, year-over-year, protects corporate margins. However, newly proposed Trump tariffs threaten to disrupt global semiconductor flows. These tariffs act as a direct tax on advanced packaging imports. This policy friction directly pressures NVIDIA's hardware assembly partners. The lab sees this friction capping near-term upside despite blockbuster demand. This is the policy reality Wall Street ignores. Geopolitical flashpoints compound these supply chain vulnerabilities. An ongoing Middle East conflict threatens to reignite energy-driven inflation. Concurrently, trade war anxieties over Greenland create sudden market volatility. This geopolitical friction directly threatens international logistics nodes. Yet, retail demand for artificial intelligence infrastructure remains insatiable. MUU became the fourth single-stock ETF, a fund tracking a single company, to cross $5 billion. This massive capital inflow highlights intense retail speculation. NVIDIA's beta, a measure of a stock's volatility relative to the broader market, stands at 2.24. This high beta means macroeconomic shocks will trigger outsized price swings. We expect extreme price swings as global trade negotiations stall. While software companies commoditize, the capital flows directly to physical silicon. NVIDIA remains the ultimate structural winner of this macro shift. The physical hardware bottleneck is where the real money is made. NVIDIA reported earnings per share of $1.87, beating the Wall Street estimate of $1.79 by 4.3%, a solid beat that signals strong execution. NVIDIA is trading below its 20-day average, currently at 214. NVIDIA just printed a 4.3% EPS beat, and the press release is dripping with AI demand and supply chain resilience. But let's talk about the 911,732 shares insiders dumped in the last 90 days. That's not confidence, that's a liquidity exit. When executives sell that volume while the stock is still near all-time highs, it's not diversification. It's a signal that the next leg of margin expansion is priced in and the board knows the physics won't keep up. The R&D spend is up 43% year-over-year, but revenue only grew 28%. That's a widening delta. Management calls it pipeline investment, but the math says they're burning cash faster than they're converting it into future gross margin. And listen to the earnings call hedge, regardless of any general incorporation language in such filing. That's legalese for, we're about to get hit with something we haven't disclosed yet. The 10Q will bury it in risk factors, export controls, CoAS yield slippage, or HBM3E bandwidth ceilings. What NVIDIA is saying is AI is infinite. What the lab hears is we're one node delay away from a 20% haircut. The momentum breakdown for NVIDIA. RSI sits at 52, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. Snow surged 35.8% because accelerating enterprise cloud spending directly validates the massive computing demand NVIDIA is capturing. NVIDIA's dominance rests on EUV, extreme ultraviolet lithography, the light-based printing technology used to etch microscopic circuits. This lithography, paired with advanced packaging, the three-dimensional stacking of silicon dies, secures its hardware lead. Transitioning to the upcoming H200 accelerator will further solidify its lucrative data center supremacy. Demand remains exceptionally high. But here's what breaks the bull thesis. U.S. export controls restrict A100 and H100 shipments to China. This cuts off critical revenue. Additionally, MACD, Moving Average Convergence Divergence, a trend-following momentum indicator, shows clear bearish momentum. Tariffs on Taiwanese imports threaten gross margins for major customers like Amazon and Google. How will Taiwan tariffs impact NVIDIA's largest hyperscaler customers? If import tariffs squeeze margins for Amazon and Google, their capital expenditure on expensive GPU clusters will contract. NVIDIA's forward P/E, price-to-earnings ratio, a valuation metric comparing stock price to projected earnings, sits at 16.9x. This valuation leaves zero room for execution errors. If hyperscalers slow their hardware deployments, the trailing P/E of 32.8x will rapidly compress. This supply chain friction is the real threat Wall Street is ignoring. We expect margin compression to hit next quarter. With an AI score of 61 out of 100, the lab holds a neutral stance. Watch the key support level at $196.50. If support breaks, expect a rapid drop. Resistance at $235.74 remains a tough ceiling. Palantir's AI Edge and NVIDIA's Blackwell RAM are underpriced, both buys. Not financial advice. Do your own research. The lab out.